It was a tough journey going from an intern to a senior professional. Now, to protect my savings against high inflation and grow my wealth, I invest in bonds with INR Bonds. Download the INR Bonds app to save better.
Hi, welcome to Bond Bytes, the daily bond market highlights from INR bonds. I am Arjun Patsarthi. And with India's retail inflation at almost 8-year highs of 7.79%, and with core inflation, which is stripped of food and fuel, at over 7.3%, which is again a multi-year high, the question is that can the inflation be contained? And for this, both the government and the RBI need to take decisive steps. Now, the government has to control inflation because if they don't, then they will get affected in two ways. They have a large borrowing program, and the interest cost for their borrowing will rise. The 10-year gsec yield, which is at around 7.3% levels. This has gone up from almost 6% levels just over a year and a half back. So it's come down from 7.6% levels. But if inflation continues to rise, then obviously for savers in the Indian households who save all their money in fixed deposits of banks, which in turn invest in government bonds, then they will be facing a big issue because all their returns on fixed deposit will be eaten away by inflation, and it's going to be very difficult for them to do any kind of saving. So the government too, if they pay more interest on their borrowing, then what it also hurts them because they will not have money to spend for infrastructure, and if they can't spend for infrastructure, they cannot create capacities in the economy, and they cannot create capacities. Supply will be constrained, again inflation will rise. So it is very important for the government to act decisively through prudent measures in terms of fiscal, in terms of everything else that they do to contain inflation. On the other hand, the central bank, the RBI, has got an inflation target of 4% plus or minus 2%. So even at the higher end of the inflation band, it's 6%, and inflation is well over that. And if continues to trend higher and stay high, then RBI has to take decisive steps on the monetary policy front to contain inflation. And the way they have to do is to raise interest rates sharply and also cut down money in the system so that demand for goods and services come down, and the prices too then tend to fall as demand comes down. That's the idea of raising interest rates and cutting down money. But if they don't do it, then again there could be instability in the economy because there could be a huge amount of other speculative bubbles, etc. And may uh, savers will really get affected, and most of the money will be going towards paying for inflation rather than spending on productive uses. So apart from that, India's export data was pretty much positive. Exports rose to $40 billion in April, up 30%, 30.7%, while trade deficit increased by again 30%, 31.52% to USD, closer to USD $20 billion. And this is due to the high oil prices recorded globally. And India is a big importer of oil. Sensex and Nifty continue to be very volatile. So we have seen FIIs on a continuous selling spree of equities. They have sold they've sold over $20 billion of equities this year. And this is a very sharp kind of a sell-off by FIIs. And when they sell equities, they take the money out of the country, and the rupee too gets affected. So it closed flat today, but it's still at closer to record lows. So the auction, the 10-year gsec auction came in at 7.33%, and there was no, RBI did not have to give the auction bonds to the underwriters, which is a positive sign because there's enough demand for bonds at these levels by the system. Do not forget to download our app, Quick Invest by INR Bonds. And if you have not subscribed to our YouTube channel, please do so. Thank you very much for listening in.